Good morning and welcome to the inaugural G&T Market Update webinar, and what a time to be delivering it. I'm Nick Rowe and will be your host, moderator and chair for this morning's session. We have had a tumultuous few months with our exit from the European market, the commencement and yet to be an exit of lockdown number 3, a new US president and the rollout of vaccines. I have a panel of G&T experts who will, over the next 45 minutes, attempt to put some clarity into recent events and give you a look forward as to what this might mean to the construction market. Rachel Collins will be touching on construction output and the state of new orders. Will Galley and Rob Webber will be giving us a view on what the trades are experiencing and saying. Kerry Gibbs will give an initial overview on Brexit and what it means to the construction market. Gavin Murgatroyd will be presenting the first look at our Q1 tender price inflation indicator for London and the UK. And finally, James Angus will be hosting our Q&A panel, bringing a project management perspective. There will be an opportunity at the end to ask questions. Please use the function at the bottom of the screen to raise these as the webinar progresses. Should we run out of time to answer all questions, we will respond to you by email or phone after the close of the webinar. In addition, an electronic version of our market update will be sent to all attendees, so there's no need to make notes today. I would caveat all this by saying this is G&T's view, based on the research carried out by our in-house analysts and what we are currently experiencing on the many £billion worth of construction projects we are involved with. Should you need further information, please do not hesitate to reach out to your relevant G&T contact. Finally, we are in lockdown, so all speakers are presenting from home. So please bear with us should we experience any IT difficulties. So to begin with, I'm going to set the scene with a brief summary of the macro outlook, starting with GDP. We have seen 2 successive quarters of decline in 2020, followed by a 16% quarter-on-quarter rise in GDP in Q3. However, in the light of the government lockdown restrictions in Q4 2020, it's highly probable that the UK will experience a double-dip recession this year. On an annual basis, 2020 will record the biggest drops in national output since 1709. GDP is expected to expand in the UK by 4.2% this year, compared to 3.9% in Europe, 4.2% in the US, and 7.9% in China. GDP from construction fell by 33% in Q2, but made a partial recovery in Q3. However, it remains some 8.6% lower than it was a year ago. Oxford Economics have suggested that we're not really experiencing a recession in the normal sense of the word, but are rather an artificial hibernation by diktat of the government. Once constraints are removed, the economy is expected to recover quickly as pent-up demand is released. However, the latest national restrictions will have pushed back the recovery from the first to the second quarter of this year. What about inflation? Well, the CPI and the RPI indicate that the UK is in a sustained low inflation environment. Consumer prices rose at an annual rate of 0.6% in December, well below the Bank of England's 2% target. The expectation is that over the coming months, inflation will gradually edge back up. A comparison of independent forecasts for the UK economy published by HM Treasury in December showed that the UK CPI on average is expected to grow by 1.9%, whilst RPI is forecast to grow by 2.6% this year. This may, however, be slightly moderated in the light of the latest lockdowns. We'll touch on this later on what this means to construction. Interest rates remain at a record low, 0.1%. The central bank has so far resisted further cuts to the base rate. The Bank of England has prepared the groundwork for negative rates, and the policymakers suggest that cutting interest rates below zero could be good for growth and would help boost inflation. No decision will be made until the Monetary Policy Committee meet this month. Unemployment, UK unemployment rose steadily in the second half of last year, between August and October, to 4.9%. It is estimated to peak at 7.5% by the middle of the year. The extension of the job retention scheme will provide a lifeline for many jobs, but it remains to be seen what happens after it finishes at the end of April. Construction vacancies have fared better, experiencing a sharp V-shaped recovery since late spring, and now are more or less on par with pre-pandemic levels. The general consensus is that despite an initial optimistic uptick from the Brexit deal, the UK economy will be starting 2021 on the back foot. But with a successful UK vaccination rollout programme, a durable recovery could be on the horizon. Let me now hand over to our first speaker today, Rachel Collins, who will shed some light on what is happening to the construction output and new orders.
Thanks, Nick, and good morning, everyone. I'm Rachel Collins. I'm a partner in the cost management side of the business, acting mostly in the commercial and large-scale mixed-use sectors. I'm going to start with a look back across 2020, using the Construction Purchasing Managers Index, the PMI, to reflect on the huge impact that coronavirus had on the UK construction industry across the year. The graph on screen is the PMI for construction, which shows month-on-month change in activity and is a really useful index as it indicates construction activity as a whole. It factors in output, new orders, and employment growth to give an overall picture of the industry. So, looking initially at first quarter 2020, taking us back to the beginning of last year, just as all of our lives changed dramatically. The PMI graph shows the significant contraction seen in the industry in the space of just 6 weeks, as progressive tightening of restrictions was announced by the UK government, culminating in the national lockdown on 23rd of March. UK construction activity went from a period of expansion to a period of sharp contraction, with the monthly PMI index falling from 52.6 in February to just 8.2 in April. Construction productivity fell as many UK contractors closed sites or paused work at the end of March, but the impact of COVID-19 on construction was really only just beginning to be seen. The main impact was seen during quarter two, with construction output down a record 35% from the previous quarter. This was a drop nearly 5 times larger than the previous record quarterly fall at the start of 2009 during the financial crisis. Similarly, construction new orders fell by 54% from first to second quarter. This was the lowest level of new orders since records began in 1964. In London, residential new orders fell by 53%, while commercial orders were down by 71%. This reflected the general pause in the placing of new contracts during the first lockdown. However, if we now look at output and new orders across the third quarter of last year, a much more positive picture begins to emerge. After dropping by record levels in quarter two, construction made a really strong recovery in quarter three, with output rising by more than 41% across all sectors, with many projects that had been delayed earlier in the pandemic restarting, showing a near V-shaped recovery. Indeed, the highest quarterly growth rate since records began was seen in construction new orders, with an increase of 89% from second to third quarter. I have to say that when initially looking at this graph and the growth rate just mentioned, I was quite surprised at the apparent speed and level of recovery. Discussing with colleagues and reflecting on what we saw on all of our schemes during last summer, we think there are a few key factors that this can be attributed to. Certainly, here at G&T, we saw the industry efforts to adapt quickly to the changing working environment. In particular, the rapid introduction of comprehensive safety protocols from contractors minimised site shutdowns and largely mitigated the feared impact on productivity. The government strategy to include construction as a key sector to remain open during subsequent restrictions also helped to release some of the bottleneck of projects that had been due to be placed in the first half of the year, but that had been paused during the first lockdown. And in some sectors, we've seen huge increases driven by the pandemic restrictions and public response. For example, private industrial new orders increased almost 140% due to changing consumer behaviours, with all of our doormats now full of Amazon, Ocado and online orders. As the stats show, it certainly isn't just me. Looking now at London, commercial new orders rose by 72% to 1.08 billion, with the total amount of office space under construction in third quarter 2020 close to its all-time high. However, despite all of these really positive statistics, it's important to highlight that construction output was still 8.6% lower in quarter three last year than the pre-pandemic level of quarter three 2019, showing the capacity that remained in the market, with a significant proportion of the increases relating to schemes that had simply been delayed from earlier in the year. Some sectors, such as London residential, actually experienced a further fall in new orders in quarter three. COVID-19 has had a significant short-term impact on London residential construction. Here at G&T, we've certainly seen mainstream residential recover more strongly than the prime market, with more home working and government schemes such as Help to Buy and the current stamp duty holiday intensifying demand. However, despite this, Q3 2020 new residential orders were well below the 5-year quarterly average. Now, turning to the very latest data from the end of last year and looking forward into 2021. December's PMI survey revealed an expansion in construction output for the 7th consecutive month, with respondents noting improving client demand, workloads, and business wins. Looking forward into 2021, the PMI revealed strong business activity growth expectations, with only 10% of the survey panel anticipating a decline in activity across this year. Considering what a dramatic year we've had, it's remarkable that ONS data shows that in November 2020, construction output for the month was just 1.4% lower than it was during the same month in 2019, when comparing just those 2 months in isolation. This all suggests that the industry has returned to relative stability by the end of last year, and that there is a really good degree of positivity as to the next 12 months. So, to finish off, despite the strong performance of the industry across the latter part of the year, the impact of coronavirus on construction in the second quarter was truly significant. The CPA perhaps shows this best with their forecast that total construction output for last year will have been around 15% lower than in 2019. And while it forecasts that output will grow by 14% this year and by almost 5% in 2022, this means that output is not expected to fully recover to pre-COVID levels until early next year. Will is now going to consider how this capacity in the market, alongside other factors, is impacting pricing of a number of key trades.
Thanks, Rachel, and good morning, everyone, and thank you for joining us. I'm Will Galley, a partner in the QS side of the business. I've got a focus on the developer-led commercial offices and the residential sector, covering build-to-rent, private for sale, and prime resi. So what I find interesting about the data Rachel presented is how it's going to be reflected in tender pricing. And that is what Rob and I are going to take you through now. We're going to give you a review of the key trades and main contractor on costs. We're going to look at what we've seen and give a forecast going forwards. I'm going to cover piling, groundworks, frame, cladding and structural steelwork. Rob will then pick up MEP, fit out and main contractor on costs. So to piling, we've seen a very competitive pricing market. We've seen contractors being very responsive to tender deadlines, and contractors have engaged in multiple rounds of negotiation. Numbers of BAFOs, best and final offers, and to some extent LAFOs, last and final offers, a new phrase for us. In those LAFOs, we've seen in some instances a 4% reduction further on their costs. We've seen rig availability in the 6 to 9 months of last year increasing, with second rigs being offered up for programme benefit. However, tenderers are still busy. There's a high number of inquiries, and there has been a reduced estimating function as office staff were furloughed during the COVID period. We've got lower conversion rates on tenders too. But there are cost pressures. Rebar is rising. HS2 is now putting a demand on those rigs, especially the larger bore size rigs. So, in a synopsis of the piling market, we've got reduced cost and improved pricing. But crucially and importantly, contractors have still got a shirt on their back. Our overall view, piling is hit the bottom, it's going to flatline for a period and then tick up towards the end of the year. So to groundworks and concrete frame, rebar costs have come off dramatically. In some instances, down 8% on supply and install rates. We're seeing rates of around £900 a tonne, which is incredible pricing. But latterly, rebar's jumped. Last month, the supply price up 20%. So there's volatility in the market with a real risk on price fixity. Concrete rates are down too. We're down from £150 a cube for a flat slab to £130 a cube, a 10 to 13% shift in pricing. We've also seen plant availability up in the period. We've had one project in particular where we were due to have 2 excavation crews. We got 8 because teams and rigs were available. That delivered us a 40-day benefit on programme, truly outstanding. Labour rates aren't rising, but there's a risk with labour supply due to positive COVID testing. It's something we need to keep a keen eye on. Forecast for the groundworks and frame market. Again, we think we're at the bottom of the pricing. It's going to hold for a period and then tick up again. Structural steelwork. We generally saw structural steelwork prices stable over the last 12 months, and we don't expect that to change. You may say, that sounds bonkers, Will. Surely steel will come off as we've got reduced starts, an office market that's under a bit of pressure, but we don't believe that. And that is because of 2 key things. We've got the rising input costs driven by the Chinese economy being back on it and eating up steelwork. We've also got iron ore production hit in key areas such as Australia, where COVID production measures meant that production and distribution were down. That is all now being reflected in British Steel and ArcelorMittal raising prices on a month basis. We think to the most extent, that's going to be absorbed by the market. Looking long term, a question I'm asking myself is, how's the structural steel market going to fare in a net carbon zero world, where we see low cement concrete delivering better numbers in terms of reduced carbon footprint? My forecast for the steel market is going to hold steady. Cladding. We saw some instant reactions on the back of COVID. We saw one project coming in 10% lower than our expectations back in May last year. That doesn't feel long term, and it feels reactionary to us. That said, we can imagine the unitised cladding market prices coming off as less schemes are in the market, and cladding contractors are pricing competitively but with lower conversion rates. That's a position we're seeing, and our friends in the main contractor market are confirming that too. But again, we've got price pressures. Aluminium is rising. We've got the movement of labour, the nomadic nature of cladding installers going around Europe and the UK, having to self-isolate before starting on new jobs. Then we've also got the neurosis around Grenfell and the price risk that that's presenting. But could they be cancelled out by a strengthening pound? Quite possibly. So, in summary, the front-end trades have seen notable reductions, down 10% in some areas. Steel and cladding have stayed broadly stable, and we can expect some downward movement in the cladding market going through the year. Material prices, yes, they're up, but we believe these are short-term. There's for sure a 2-step market in place. We've got some contractors, both main contractors and trade contractors, actually very busy. That's because they've got delayed starts and have been successful converting tenders. However, other contractors haven't been so lucky and are out there really hungry for work. So crucially for us, we are keeping a really keen eye on the main contractor and trade contractor market and supply chains to ensure that we target those with the best capacity for our jobs. Rob, over to you.
Great, thanks Will. That was a really interesting insight to the key trades there. So, hi, my name is Rob Webber. I'm a partner also in the cost management team. I work primarily in the commercial sector, but also look at mixed use. And most recently, I've been looking at retail repurposing. So today, I'm just going to take you through the finishing trades, as it were, and the mechanical and electrical services trades. So these are trades that primarily use pre-manufactured components and goods. Typically, we would have mechanical and electrical services as its own distinct slide, but we're actually seeing a really similar pattern. So what's happening? Well, starting with key material prices, we're seeing price rises. So Will's already mentioned the increase in steel. We're also seeing copper up by £1,000 a tonne and timber up by around 20%. So why has that happened? Well, what we've actually seen is a direct result of COVID-19 and the impact last year it had on the market in terms of factory closures and the impact that had to manufacturing components and goods. So we've also mentioned as well, we're seeing steel increases in iron ore prices and also issues on supply. Before we move into labour and talk about the labour market, there's a word of caution we need to pick up, and that is around caution on non-tariff barriers. So what we're seeing in the market is the goods coming in and out of the country as a result of the EU withdrawal agreement causing some issues. It's not widespread, but it's something we're going to monitor in the coming months. Just last week, I spoke to a subcontractor who had a £200,000 lighting order that was slapped with a £10,000 surcharge associated with the impacts of Brexit. So that's not widespread, but something over the next 2 to 3 months we're going to monitor to see if it's included in the tender pricing. Okay, now on to labour. So what are we seeing in the labour market? Well, it's actually remained quite stable. There were some concerns at the end of last year that we were seeing labour leaving for the EU and whether or not that labour was going to come back to the London market. So that actually started quite slowly, and we actually had some issues at the start of the year, the turn of the year, but now I'm really pleased to report that actually that labour has returned back to normal levels. Okay, so what does that mean to material prices and to labour? What does that mean to our actual trade package pricing? Well, we've actually seen that despite those material prices, the subcontractors are actually absorbing those material costs. So the market is more competitive and they're able to lower their contractor margins in order to pick up pricing. So we see a good outlook over the next 6 to 9 months with some relatively good competitive pricing in the market. I think the key, as Will mentioned, is making sure we align our supply chain to the projects we're working on and make sure we have really good engagement. Okay, moving on next to main contractors. Everybody's favourite topic in the office, trying to understand what's going on in the market with those key contractors. So, to our surprise, we've actually seen main contractor prelims remain relatively stable. It didn't quite make sense to us because we thought with weakening of demand, we would see some more aggressive pricing. So what's happened is actually the impact of COVID. So the contractors have had longer working days and they've had to put in additional health and safety measures. They've learned lessons from 10 years ago when we had the credit crunch, and they're no longer prepared to work at lower margins. They want to make sure they have good quality work and are able to meet their targets. Where we have had some joy is on overheads and profit, and we've seen over the last 12 months, overheads and profits have actually reduced and come off by around 0.5% to 1% across the tier 1 and tier 2 contractors. That's already been priced into our cost planning. So going forward, we actually see that remaining quite stable. So I think what are our takeaways with the main contractor market? It's around making sure, again, we have that engagement and we have with the supply chain. We talk to our contractors, something that we actually really enjoy doing. And we also make sure we have a careful procurement plan, making sure that we have market awareness and we have a strategy that can take the ability to get the most competitive pricing. An opportunity that came up at the end of last year, I was in the middle of a 2-stage design and build procurement. We had 4 contractors tendering on a first stage for prelims, overheads and profit. And what we actually saw was one of those 4 contractors came forward and offered up to fix the mechanical and electrical package worth around 15 to 16 million pounds, which would have been about half or 50% of our contract sum. And I think that just goes to show you that there is some appetite in the market to go a bit further to make sure these contractors are actually securing their pipeline. Okay, so what am I telling my clients? What's my insight? Well, I think over the next 6 to 9 months, we're going to see a relatively stable but competitive market. I would urge a word of caution around the end of the year and the potential for pent-up demand hitting the market. So what we might see as we come out of summer and into the end of the year is some pricing volatility as the increased tendering activity might hit us. So I'm just going to pass you over now to Kerry, who's going to give you an update on the EU withdrawal agreement and the impact that's had on construction pricing. Thank you.
Thanks, Rob, and good morning, everyone. I'm Kerry Gibbs, and I'm a partner in the cost management division of G&T. I oversee a team working on a number of projects in both the residential and commercial sectors. So Brexit, well, finally, we have a deal. So yes, we do have a deal, albeit one that is considered as thin. So for now, here's a whistle-stop tour of the agreement and our thoughts on what it means for us. Let's start with goods and standards. So good news, 0 tariffs. The no tariffs mean immediate material price increases have been avoided. And tariffs have been a major concern for contractors, with resistance in the market to take the risk on this element. In some instances, this risk has been managed by the inclusion of provisional sums, which were to be firmed up when this element could be quantified. So these provisional sums, of course, can now be omitted from contracts, as this no longer poses a risk. However, we will have increased customs checks and controls at borders from the beginning of this year. There is a transition period until the end of June, with extended deadlines for paperwork to be filed on imports to the UK. And although the trade agreement aims to reduce new administrative burden and barriers, you will have heard in the media that UK businesses are finding there has become a significant increase in paperwork, and that vehicles are being held at the borders for increased periods of time. EU businesses are also suffering. You may have seen in the news last week that Tupri, the French manufacturer of decorators filler, stated that they were increasing stocks in their UK warehouses to try and mitigate these issues. And as Rachel mentioned earlier, the market has seen an increase in warehouse distribution centres, and this could increase as businesses look to manage the supply of their materials and products. So we know it's not just down to all our internet shopping. Of course, moving forward, the industry will have greater certainty on what this actually means for the lead-in times and availability of materials. But however, for now, it would seem sensible for those of us with projects on site, or with projects planned to commence on site in the summer, to review our programmes and logistics strategies, with the possibility of increasing the use of project consolidation centres to mitigate this risk. Let's just touch on CE marked products. These will be allowed in the UK market until the end of this year, but the intention is to end recognition of the CE mark and introduce a new UK CA marking. So over the next year, let's make sure that we and our designers review our specifications with this specifically in mind. Right, now let's look at labour. As we all know, free movement of labour finished at the end of last year. A new global points-based application system is introduced, and sponsorship costs to bring workers to the UK will be prohibitive to some employers. So what does this mean? Well, historically, circa 30% of construction labour came from Europe. And although the effect of these new restrictions is difficult to determine at this stage, the industry is expecting a reduced labour pool, with some speculating that labour costs will increase above inflation. The dynamics of the UK construction labour market are complex, and the impact that Brexit and the pandemic will have into 2021 and beyond is not yet clear. But regardless of the cause, fewer operatives on site will impact productivity and lead to an increasing number of notices and potential delays being issued during this transition period. So what should we do? Well, let's ensure we review our current contract provisions and ensure future contract drafting acknowledges the potential risk to both employers and contractors so that we can implement strategies to minimise and manage this. I think insisting that contractors provide us with anticipated resource schedules, which are reviewed against actual attendance on site on a weekly and monthly basis, is a good starter for 10. Let's briefly touch on professional qualifications. There's currently no mutual recognition of professional qualifications under the trade deal. However, it is the intention that the UK and EU will agree mutual recognition arrangements, but this is now unclear. Right, and finally, let's talk about public procurement. So the UK will maintain a separate and independent procurement regime. From the beginning of this year, contracting authorities will no longer be obliged to publish notices in the official journal of the European Union, or OJEU. Instead, a new UK e-notification find a tender will be used. The trade deal provides for a framework of rules for trade in public procurement based on the government procurement agreement. And GPA members commit to open up their public markets to contractors from other member countries. So as a result of this, UK business will still be able to compete for public contracts across the EU, although on a more limited basis than before. This is obviously early days for the framework, so let's watch this space. So what does this mean? To conclude, it's anticipated that confidence will return this year now that a trade agreement's been signed. However, a word of caution, we are entering a transition period, so we must stay on our toes. We need to be mindful on the potential costs and delays associated with restrictions on materials and labour, and the risk these pose to our projects. And interestingly enough, the challenges of Brexit seem far less daunting following the challenges the industry has faced as a result of COVID. So I believe we have the skills necessary to navigate our way through any issues that may arise. And let's use the lessons learned through the pandemic and the necessity for close collaboration to ensure this transition period is as smooth as possible. As an industry, we've got this. So I will now hand over to Gavin, who will explain how all of this will affect our tender prices.
Thank you, Kerry. Good morning, everybody. I'm Gavin Murgatroyd. I'm a cost management partner specialising in the commercial office sector for developers and occupiers, as well as the higher education sector. Well, lots of interesting information, stats and figures there from all my partners. How do we make sense of it? Well, forecasting's not easy at the best of times. Throwing in a global pandemic and an unprecedented breakup of the European Union, and it makes life pretty interesting. But it's worth looking back at the last time we had a big economic shock, which was the 2008-2009 financial crisis. And if we look back at the ONS GDP statistics, you will see there that back in 2008 and 2009, we had a year of decline of GDP growth. So before any real growth continued over the next 4 years, it was really quite sluggish. Contrast that with the COVID pandemic impact and the economic shutdown, and we've bounced back really, really quickly. And whilst we've heard there's some short-term volatility and some sensitivity around this current lockdown, the forecasts are that GDP will recover and grow pretty quick. If we look back now at the construction sector in specific terms of GDP, it really has been the star performer. And it just shows the strength and resilience of the industry. And that, yes, we dropped, but coming back towards the end of the year, it was the main contributor to output growth. And actually, as we've heard, the levels are pretty much back to pre-pandemic. Now, if I compare that to the G&T tender price indices over a similar period, you'll see there that effectively we had a very, very long decline of 4 years of tender prices, which, as we know, is on the back of demand and recovery of projects. Contrast that now, and we're expecting a recovery within 2 years, so much sharper as economic growth comes back. Now, tender pricing is a complex thing. We've heard about lots of statistics and lots of factors. And in order to get to a satisfactory outcome, we have to consider all the things at the same time. So we've heard that global demand is returning. The raw materials prices are increasing. We can't be immune from that. That is definite upward pressure on our pricing. We've heard that COVID has an impact on pricing in terms of productivity and measures that have to be put in place. That's upward pressure that we can't get round. Similarly, there are potential issues with supply chain disruption and availability of labour due to the Brexit deal, which may get worse this year, may improve. Then contrast that with the overall economic demand. We know that things were turned off last year. There was a reduction in pricing. We saw -1% year-on-year growth last year for 2020. Similarly, we've seen pressure on labour rates due to the lack of demand of jobs out there. The simple economics dictates that it's better to have some work at a lower price than to have no work at all. And we're seeing that type of behaviour in the market. Then we're seeing pressure on overheads, profits and margins. There is less work to tender out there. So what does a contractor have to do to win that work? He has to trim his margins. All these need to be balanced, and we need to think about that in terms of our overall forecasts. So What are we thinking? Where are we crystallising? Well, if we look now at the UK average, as I said, last year, we were -1% year-on-year growth. We're still forecasting for this year a -0.5%, but actually that's an improvement from our last forecast, where effectively we were another -1%. So it's a growth of 0.5%. So it's good news, the market's growing. Similarly, into 2022, we're showing growth of 1%, and into 2023 and 24, 1.5%. That's all predicated on the back of increasing demand towards the back end of this year and into next year, and towards our long-term 20-year average, which is about 2% in a normal growth market. Similarly for London specifically, good news there again. Again, we had -1% for 2020. Whilst we're still down this year at -1%, that's improved from -1.5%, and then moved quickly on to 2022 at 1% and 2023 at 1.5%. Again, moving towards our long-term averages in the growth market. That's our current view, our crystallised position. Obviously, it's constantly changing, and in this pandemic world, it's been changing on a week-by-week basis, never mind quarter-by-quarter basis. But I hope that provides quite a useful insight into our current thinking. And I'll now hand back to Nick.
Gavin, thank you very much for sharing the first look at our TPI figures. I think I'm right in saying that these will be formally released in the next few days. So we've all had an advance view. I'd also like to thank Will for calling in from the Alps. Good that he's come all that way just for today's session. It's now time to respond to a few questions. There's a number that have been raised. We've got about 7 minutes. So any we don't get to, we'll respond formally to after the webinar. So I'll hand over to James to take us through the questions.
Thanks, Nick, and good morning, everybody. My name's James Angus. I run part of the project management team here in London. My team focuses on commercial offices, residential sector, and hotels and leisure. And as Nick has said, we've had some great questions in. We might run over by a couple of minutes because I'm keen to try to get through 4 or 5, which I think will help illuminate some of the points that we've made this morning. The first question is actually in relation to programs and productivity. So Hull, if I may take this first question. The question is, how is the ongoing pandemic impacting construction programs and individual trade durations? Great question, a question we are repeatedly asked. I'd like to answer that in 2 parts. Firstly, with regard to construction activity that is ongoing, so projects that are on site now, it is very much a mixed message. I think that shell and core trades, early trades, demolition, groundworks, substructure, and to an extent superstructure have fared much better through the pandemic, with social distancing measures much more easy to absorb. And I would say what we've found is that those early trades have largely recovered to pre-pandemic levels of productivity. But it's not so much the same with regard to finishing trades. They continue to struggle, which again is a function of having lots of labour in confined spaces. And we do still see a lag there with productivity, anything from 10 to 30%, often further exacerbated if it's a high-rise building and you've got difficulty getting labour up to site. Now, if we're looking at work that we're tendering through this year, I think the outlook is more positive. So with projects that are perhaps 2 to 3 year, maybe even longer durations, what we're seeing is main contractors are more willing to look through the pandemic. And that's a function of those finishing trades I mentioned, which are still suffering from productivity losses, being at the back end of any programme. So just to summarise, projects that are on site will continue where finishing trades are on site now to suffer from productivity losses, but we're more optimistic with projects that we're bidding during this year that we will not see any residual delays. Of course, there are subtleties to that, but that's our view in the main. Okay, the next question, Gavin, this is probably one best for you to answer. From the analysis you have provided, I'm surprised there isn't greater potential for further contractor price discounting through 2021 and beyond. Can you explain why, in the midst of an ongoing pandemic, we won't see further significant reductions in construction inflation?
James, thanks for that. That's a good question, and one that I've been asked several times by my clients over the last few weeks. I think for me, there are three things why we won't see that. Firstly, we are under pressure from increased materials costs from raw materials on a global picture. Oil, steel, copper, we've just heard we're not immune to this. So base prices are increasing significantly on a global level, and we can't get around that. I think secondly, contractors have been very lucky to have continued working during this pandemic. Prior to the pandemic, they were already very busy. So they've gone in, particularly tier 1 and tier 2, with full order books and have managed to continue that workload through. So actually, there isn't a need for them at the moment to trim too much. And why would they take pricing on at a loss? Then I think, thirdly, I think the overall macroeconomics outlook is very different, in that we're in a low interest rate environment compared to the last economic shock. And there are £895 billion worth of quantity of easing out there. So liquidity is not a problem. So demand is still out there, and we think it's going to gather and come back. So that for me is the three things as to why we're not seeing that.
Thanks, Gavin. Will, just turning to you, you spoke about early trades. Do you think there's any scope for those early trades to further reduce margin?
Thanks, James. That's a great question. So we obviously saw rebar pricing and concrete pricing coming off in that early part of the year. The rebar pricing for sure was reflective of a material price drop. I think some contractors did take haircuts on some of their overheads, but is there capacity to go further? Yes, I think there is. Will contractors choose to do it? I'm not sure. And as I said, a lot of them have still got, or all of them in my view, have still got their shirt on their back.
Yeah, and I guess as Gavin and you have already said, we are seeing input prices going up, which maybe reduces further their ability to further reduce overhead. And Rob, what about main contractors? We did see overhead and profit reduced through last year. Again, do you think there's much scope for more of that this year?
James, as you said, and as Gavin kind of touched upon, I think, yeah, we have seen OH&P reduced last year. But I think particularly for the tier 1 contractors, this time around at least, they seem much more aware of the situation they got themselves into last time. And I think they're less keen to do more work for a lower margin. So I think they're going to work for higher margins with less work.
Great, thanks. Okay, next question. Rachel, I'm going to pitch this one to you. It was interesting to see from your earlier analysis that construction output in the third quarter have recovered significantly. Where in your key markets are you experiencing this growth, and do you expect all key markets to recover equally through 2021-22?
Thanks, James. Yes, that's certainly an interesting question. I think, well, firstly, just to highlight again, I did touch on it earlier, that absolutely output and new orders did recover towards the end of last year. But, overall output for construction last year is still expected to have been 15% lower than the year before. So, all sectors were impacted to a greater or lesser degree. Thinking about some of our key sectors, I think infrastructure is one really to flag as having a very strong recovery at the end of last year. I think some of the factors you mentioned about which trades are most impacted by the social distancing measures had an impact there, with infrastructure schemes perhaps slightly less impacted than some other projects. But also there was some, really big commencements of major infrastructure projects like the main works at HS2 in the third quarter of last year, which really did bring on some growth in that sector. And I think we would expect that to underpin infrastructure growth this year and into next year. Thinking about private residential, especially in terms of new build. Again, another area that last year finished quite strongly, with quite a lot of pent-up demand, with things like the government's Help to Buy scheme and stamp duty windows closing early into this year in March. I think that will probably ease some of that demand, and that sector will probably be a little bit more tied to the general recovery in GDP that's forecasted perhaps towards the back end of this year and into next year. I think myself and Kerry both touched on the industrial sector recovering strongly last year due to increased demand for distribution centres, warehouses, etc. And I think it's looking likely that social distancing measures will continue for some time, which will continue to positively impact that sector, I think, certainly in the short to medium term. Some of our sectors, such as retail and hospitality, have clearly borne the brunt of the coronavirus restrictions, and we're still in a lockdown. There's very little clarity as to the timescale and extent of loosening of those restrictions, so it's quite difficult to predict strong growth in these sectors in the short term, certainly at the moment. And then finally, thinking about private commercial, that also recovered really quite well in the third and fourth quarters of last year. I'm sure you're aware there's quite a lot of debate at the moment about what the post-COVID office of the future might look like, and whether the trend to home working will continue once everybody's been vaccinated and restrictions have loosened, and that may have some impact on new orders for commercial in the short term. But I mean, having said that, certainly within my team, we've seen very little impact overall in relation to schemes being paused or significantly pushed back. And I think clients are quite keen to take advantage of the opportunities in the market that both Will and Rob have touched on, and particularly now that we've got the extra level of certainty with the Brexit deal having been done.
Great, thanks Rachel for that comprehensive answer. Nick, one for you, I think. Are you seeing any shifts in the appetite of main contractors to participate in more competitive tendering, for instance, single stage as opposed to two stage?
And then I thought I was going to avoid questions. Never mind. Yes, I think there's been the ability to single stage tenders with tier 2 and below for a while, especially on projects that are sub 30 million, and where the projects are well designed and with little risk. I think there's still a lack of appetite in the residential sector, although we are seeing a push to lump sum tendering in earlier packages and the construction of basement boxes. Less so on the fit out element. Not many people want to take on that risk. There's still little appetite from tier 1 contractors, maybe more so at the end of the year if the market doesn't open up post-COVID. In terms of the fit out market, that remains very competitive. Lump sum tendering is still very much the norm.
Thanks, Nick. I'm just going to ask one final question. This is to you, Rob. I think you do a lot of work with occupiers. Are there any signs that occupiers are reducing their space requirements, or indeed changing the way that they propose to occupy office accommodation? Hot topic there.
Yeah, no, really interesting question, and something I've been asked before. So I think what we're seeing is quite difficult at the moment. We're in lockdown 3. It's quite hard for tenants to kind of make those decisions in terms of what their long-term planning is. So we have seen some of those decisions go on kind of hold as clients are trying to understand what the future looks like. I think if we look to the pre-COVID world, we already had a rise of agility working, collaborative working, an improvement in the quality of commercial space, the need for improved amenities. So that was already happening pre-COVID. So I think what we're going to see in the future going into 2021 and 2022 is that kind of continued rise of agility working. More collaborative space will be required. Tenants are going to want more amenities. We already had a rise for quality office space with fresh air and all of that kind of thinking and trying to hit net carbon zero targets. So I think what we're actually going to see, yes, tenants might want a slight reduction in space, but it's not going to be dramatic. What they're going to need is better amenities for their employees when they do come into the office, and more collaborative space. So I think it's going to be interesting, but I think until, hopefully we'll be back into the office soon, and some of those decisions can start to peter out. I know we're feeling quite disconnected in lockdown 3 and kind of really fed up. So I think everyone wants to get back to the office in some shape or form.
Yes, we definitely do. Okay, Nick, that's I think all we've got time for. Over to you to wrap things up.
Great, thanks, James. I'd like to say thank you to the panel for all their insightful views. Thank you to all our guests who made time to attend our webinar this morning. And finally, before we go, I thought I'd leave you with a question. So, if, as we suggest, there might be some short-term savings in the market before the country and construction industry opens up, is now the time to push the button on your development pipeline and avoid the potential bottleneck that may be coming. As ever, please do not hesitate to contact your G&T expert for further views and information. Thank you very much and see you soon. Bye-bye.